Science gave us some hope. The economic numbers, they gave us none. This is Bloomberg Wall Street Week. I'm David Westin. Welcome back. Another week of being at home, at least for most of us. Also another week of really deteriorating economic numbers, both in the United States and over in Europe. But maybe this week, really what was more important than the numbers about the economy were the numbers about the disease itself. As the number of cases, the number of hospitalizations, and even the number of deaths started to plateau and even drop off in some of the hottest spots. And on top of that, we got news of a possible treatment out of Gilead. And the person who's become our guru on the pandemic, Dr. Anthony Fauci, called it quite good news. Through that all, the equity markets did rather well. In fact, in April, they were up more than in any month since 1987, any month in 33 years, albeit giving up some there at the very end. At the same time, we got some indications this week that some parts of the economy and some stocks may do better than others. And to take us through which they may be, we welcome now our Wall Street Week contributor, Gillian Tett. She's chair of the editorial board and editor-at-large for the United States for the Financial Times. So, Gillian, welcome. It's great to have you. And particularly, you wrote a column toward the end of the week, really redirecting investors' attention back to the difference between liquidity on the one hand and solvency on the other. That's always important, but why is it particularly important right now?
Well, it's particularly important right now because we have had this extraordinary disconnect between the economy and the stock market, where we've had a string of absolutely dreadful news, 4.8% contraction in the first quarter. You have analysts predicting that peak to trough, you're going to have a 12% decline in GDP in the first half of the year in America, dreadful numbers out of Europe, and yet the stock market have rallied, although they did come back quite significantly on Friday. And one way to make sense of that is a lot of investors, when you speak to them about why they're so optimistic, if they are optimistic, they say, well, it's because the Fed is backstopping everything. You know, think about that $5 trillion worth of asset purchases we've had from the large central banks, half of which comes from the Fed. The issue at stake is, as I wrote in my column, that can help address a liquidity crisis, a credit crisis. What it cannot do is address a solvency crisis where you have a bunch of companies and consumers who simply have too much debt to ever repay out of their revenues, which are now collapsing. And although we primarily had a liquidity crisis in the first stage of the COVID-19 shock, we could now be morphing into a solvency crisis if this problem continues, if the lockdowns continue, if we don't have a rapid medical miracle. And that is something that the Fed cannot deal with, nor in many ways can the Treasury.
Exactly. The central banks can tend to deal with liquidity. It's harder in solvency. At the same time, did we see some evidence this week of maybe some sectors that are benefited actually on the fundamentals? We saw some tech numbers that came in very, very strong. Healthcare also seems to be doing well as opposed to some other sectors.
Absolutely. Right now, it really is all about tech and healthcare, and those are the sectors driving things upwards, which is quite understandable because we are seeing this extraordinary dash towards essentially people adopting technology on a scale and degree that we never think was going to be possible. We had Microsoft coming out and saying essentially tech adoption had been accelerated by 2 years compared to what they'd been expecting. And at the same time, obviously, healthcare stocks are doing a lot better. We've also seen a lot of consumer goods stocks doing quite well too. That's quite striking. And on top of that, we've had problems, entirely expected problems developing in the airlines, in retail, and sectors like that. So it really is
even there, Stephanie, it strikes
a tale of two cities, if you like.
Sorry,
very
go ahead.
Stark contrast. It's a tale of two cities, very stark contrast between some sectors doing better than others. And that's going to be the story increasingly in the months ahead.
Stephanie, it strikes me that one of the things that's important is we're starting a new month now. Rent comes due on May 1. Where are we with the real estate market?
Well, that is a huge question because Friday is truly a critical issue, the 1st of May, because we saw already a lot of non-payments for April. And the problem with that is that starts to create a cascading domino effect along the whole chain of obligations that essentially normally make capitalism work. And if May is going to be worse than April, which is what everyone is expecting, I'm hearing stories from some bankruptcy lawyers that maybe half of all rents will not get paid in major urban centers, then that's for the commercial real estate sector. Then essentially that's going to put enormous pressure on commercial real estate companies. We've had people like Tom Barrack from Colony, which is basically one of the big commercial real estate players, essentially saying that there could be huge problems coming down the road. And that's a kind of chain reaction that starts to really put solvency on the map for investors and for policymakers. Because the other thing to realize is when you have a crisis of this magnitude, if you have a sudden shock decline in GDP, you don't have companies going bankrupt immediately because they often have a bit of money to keep themselves going with. It really takes a rolling process of the problems going down the chains of debt, down the payment chains, for the pressures to start to emerge. And that's why essentially the 1st of May is so critical, because if those rent payments are not paid, that's just one more sign that we're starting to slide towards that kind of chain reaction.
And as you say, there's a limit to what the central bank can do about that problem.
Well, unless they are going to go and basically either implement a complete debt freeze, a debt jubilee, and you are hearing discussion about that. You are hearing people say that should be the case in the consumers as well, because there's another set of problems brewing in the whole mortgage market on the retail side, and questions about whether essentially wholesalers are going to pay mortgages, whether they're going to be given a moratorium, what that would mean for the whole mortgage market going forward. But essentially, if you do start to see these essentially non-payments developing, either the government steps in and says, okay, we're going to freeze everything, or the lenders do, or you start to get a lot of defaults. And that's a mess.
Right. Yeah, indeed. Thank you so much to our contributor, Gillian Tett from the Financial Times. Coming up, the central banks got to work this week. We talk with former Fed Chairman Alan Greenspan about how different it is this time.
How we come out of this thing is going to depend very much on fundamental issues with respect to government.
This is Wall Street Week on Bloomberg. Welcome back to Wall Street Week. I'm David Weston. The economic numbers kept coming in worse this week, and the central bankers, well, they were listening. We talked with our Wall Street Week contributor and senior executive editor for economics at Bloomberg, Stephanie Flanders, about just how bad those European numbers are.
I'm a little bit reassured in a funny kind of way by these numbers, which obviously relate to the first quarter, so not before we had some of the biggest lockdown measures in some of the economies, because it suggests that we have a handle on how this is affecting the economy. It's not much of a silver lining, but actually our economists at Bloomberg Economics, we had been looking at more high-frequency data and looking at some data that the French had pulled together on the impact of lockdowns. And our numbers were a bit bigger than the consensus, and they've been kind of borne out by this. So not to gloat, but at least it suggests that we have a handle on what the second quarter is going to look like, what the impact of these broader lockdowns is going to be. And we might also start to take some heart from the high-frequency numbers we're looking, for example, at Germany, where electricity usage is starting to pick back up. We are starting to see some benefits from that slow move away from total lockdown. But of course, the big picture is still a historic decline.
Stephanie, you have a handle perhaps on the numbers and how bad they're likely to get. Do we have a handle on what needs to be done about it? We had the ECB come out and make some changes today to try to help things. At the same time, Madame Lagarde said we really need a coordinated fiscal stimulus. I think it's fair to say that both in the United States and over in Europe, the first response is we have to really protect the supply side. But how do we get the demand going again with all the consumers having sat home for so long and, frankly, being concerned about their health?
Yeah, and we've seen that, as you know, in Wuhan, some of the places that have had, a removal of the supply side shock, if you like. People are going to work, they're in the factories, but the demand's not coming back. People are not going back to restaurants, they're not going out to spend. So, of course, that is a worry. I think the fiscal programs so far, the national policies, have been all about keeping the economy in suspended animation, keeping jobs in place. And they've been quite successful at that. I think probably more successful than the states. But where they may be missing, and where certainly Lagarde, the European Central Bank, will be looking for more from governments and from the European Commission, is that piece you're talking about, the stimulus. Once we start to see economies slowly moving out of lockdown, as we now are, what's going to be there to actually stimulate economies, as opposed to just keeping them on hold, which is effectively what they've been doing for this period of lockdown. But so much uncertainty about the path of that lockdown from here, because we know Germany, for example, is starting to see a push back up in infections. So other countries are looking and saying, maybe we can't follow in Germany's footsteps.
So, Stephanie, to bring it back to the United States for a moment and to compare and contrast, we heard from the Fed and the Fed chair. One of the things he said was over the medium term, not just the short term, the medium term, we really have challenges. And he suggested even there might be longer term damage. We have had the fiscal stimulus, at least a lot of it here in the United States. How can we learn from the U.S. experience as it applies to Europe?
I mean, I think we have seen a willingness, if you like, to have more people join the unemployment rolls and then increase that support for people who are unemployed. So we had more jobless claim numbers today from the U.S. That's been, if you like, the U.S. way, that they've been less protective of employment, but pushing a lot more money into the economy and perhaps getting it to businesses as well, though we know not some states more than others. So I guess there is a lesson there, but the worry the Fed is stating is pushing all these people out of work. It would be nice to think that a lot of this work will immediately spring back, gig workers, younger workers may be able to be flexible. But we know historically, once you lose your job, especially if you're at the beginning of your career, you can have a permanent hit in terms of wages and you can find it permanently harder to get jobs. So that's the kind of longer-term hit that the Fed is talking about, and frankly why they're seeing maybe unemployment not getting back in the 4 or 5% range for several years.
That was Bloomberg's Stephanie Flanders. One thing that the Fed confirmed for us this week was that the old rules, well, they've gone away, at least for the time being, including concerns over things like fiscal discipline. That's something that was eerily confirmed this week by Chair Powell as he repeated something that we'd heard earlier from Chair Bernanke 12 years ago.
We are in a situation where the deficit is large. That's not totally inappropriate given the nature of the emergency that we're facing, and not totally avoidable given the loss of tax revenues associated with the decline in the economy.
I have long time been an advocate for the need for the United States to return to a sustainable path from a fiscal perspective at the federal level. This is not the time to act on those concerns.
We talked with former Fed Chair Alan Greenspan about whether this crisis is fundamentally changing the way the government regulates the economy.
We are moving in directions which are quite surprising, and obviously the virus issue coming up has made us a very much more difficult problem to deal with. But how we come out of this thing is going to depend very much on fundamental issues with respect to government. And it seems ironic that I'm saying we ought to be looking at Sweden, which used to be the quintessential socialist society, as the measure which we ought to direct ourselves at to get our system in more balance. And I speak to a lot of people, very few people listen.
Well, so we're listening, and we want to hear what you have to suggest, because any crisis, from what I've read in history, can give opportunities as well as real perils. If we were to, forgive the expression, use this crisis to move the economy, move the government in the direction you think would be more constructive, how would we do that?
Well, I think the first thing is to recognize that what the data remarkably show is that for the last 50 years, social benefits have been crowding out gross domestic savings in the United States, dollar for dollar. And that has meant effectively that if gross domestic savings is being reduced, that's being the major source of gross domestic investment, then we are dealing with a situation where productivity growth slows down, which is precisely what has been happening. And if what we need to do, we're now at a 1% annual rate of productivity growth. That's intolerably low. And unless and until we can turn it up, and the only way we can do that is by structuring our investment towards capital goods, and we're not doing that in an effective manner at the moment.
There are some who are very concerned about what's going on in the government right now because of what is called moral hazard. That in the effort to bail out companies, that we are bailing out some who have been profligate, not just those who have been prudent, including investing in things like high-yield bonds and things like that. Is this a time to be concerned about moral hazard, or should we put that to one side and deal with the much bigger hazard of the coronavirus?
I think it's to put it aside. It's not a. I agree it is an issue, but there are lots of issues which we can deal with without really being concerned about them.
And Dr. Greenspan, how do you assess the situation with unemployment? Obviously, we've lost 26 million jobs or so in 5 weeks. There are projections it will get worse. Some people say it may even get to an unemployment level that beats what was going on during the Great Depression. What do you project in terms of unemployment through the rest of the year?
Well, the problem basically is we actually are looking at the terrible first quarter, obviously. Second quarter is pretty awful. But if the issue of the virus works its way the way we expect, we probably have a very strong third quarter. But my concern is the fourth quarter and beyond. It's the years ahead where the changes have got to be made. And I would be less concerned about many of the issues which confront us today, although I do say, importantly, the virus issue has got to be resolved in a rational and sensible manner and change, for example, Social Security benefits and the way they are paid so that we don't run into the crisis that Sweden ran into as a consequence.
Briefly, in conclusion, what's the one thing that you would recommend if you were called up today by whoever's in charge and said, what should we do? What would you tell them?
First thing I wouldn't do is lift up the telephone.
You wouldn't pick up the telephone and take the call?
I do talk to my clients, and I do give them my views, but I try to keep my nose out of federal affairs.
That was former Fed Chair Alan Greenspan. Coming up, we talk with Eurasia Group's Ian Bremmer about what the pandemic is doing to and inside China.
We should recognize that Xi Jinping is actually in a more difficult position now than at any point since he started leading.
This is Wall Street Week on Bloomberg. Welcome back to Wall Street Week. I'm David Weston. President Trump complained again this week about what China did not tell us about the coronavirus in the early stages. Whatever the truth that ultimately comes out, experts tend to agree that President Xi has not been benefited inside of China by his handling of this crisis. That is something we talked with Ian Bremmer, the president and founder of Eurasia Group, about.
Internally, the fact that Xi Jinping did cover this up for the first month caused enormous opposition to him domestically that they needed to battle. This was by far the biggest crisis that he has faced, just like other leaders around the world. And, of course, since then, their economy is now restarting, and there was a tremendous quarantine. There's a lot of pride around that. But there was still a lot of domestic opposition. And on top of that, internationally, the Chinese are the economy that's restarted. That's good for supply chain for them. but they're also increasingly having fingers being pointed at them, especially by the United States. And if it turns out that the United States and China are in a Cold War on the back of Xi Jinping's mishandling of this, again, a big crisis. So, I see a lot of media around the world that says that China's economy is in best shape coming out of this, given the nature of authoritarian state capitalism and surveillance. All true. But we should recognize that Xi Jinping is actually in more difficult position now than at any point since he started leading. And leaders I've been talking to increasingly question whether it's clear that he would get a third term in 2022. So a lot of domestic polarization in China right now.
Well, that's fascinating. I mean, I thought he was essentially president for life. Do you think that that's in question? And further than that, Ian, if he feels cornered, does that make him more dangerous?
He certainly, when he declared himself, this core leader and ended the term limits in China, that was a very big change from the way we thought about this group of faceless lead bureaucrats that always kind of rules by consensus. It was moving from that to a more, sort of Russia-style authoritarian leadership. Well, there's a lot of backlash. And again, the scale of this crisis is pretty big. I don't think the story's been written yet, and we have until 2022. But clearly Xi Jinping knows that he has not handled this well on a bunch of fronts. I mean, you remember the initial whistleblower, the one that was punished and eventually caught the coronavirus and died. The Chinese government eventually apologized for having mistreated him and is now considering him a hero. You never see the Chinese leadership do something like that. That happened on Xi Jinping's watch. There's been a lot of that over the last few months. And again, I think the point is that as much as it seems from the West that China is stronger now than they have been historically, let's keep in mind that this is also a really bad recession for China. The economy is going to be harder to manage. It's going to be harder to keep everyone in full employment, harder to get supply and demand back to where it was. That's a problem for Xi Jinping that he never thought he was going to have coming into this year. And there are a lot of people inside the country, leaders in the country, that feel like his style of leadership has actually made China internationally and domestically more vulnerable.
That was Ian Bremmer of the Eurasia Group. Coming up on Wall Street Week, former IBM CEO Sam Palmisano is here to talk about a week when tech was front and center and appeared to be leading a path forward.
The consumer will change, and as a result of the consumer changing their consumption patterns, it creates opportunities for big tech.
This is Wall Street Week on Bloomberg. Welcome back to Wall Street Week. I'm David Weston. Equity markets this week overall held up reasonably well, although below the surface, clearly there are some winners and some losers who are emerging. And judging by the results this week, big tech is tending to come out on top. That's something we talked to former IBM CEO Sam Palmisano about, a Wall Street Week contributor.
I think that the broader trend long term for tech is how behavior is changing and how tech is facilitating that change. There's some classic examples. One, I think that leaps off the charts is telemedicine. I mean, telemedicine obviously uses the connectivity technology, whether that be WebEx or Zoom or whatever it happens to be. But fundamentally, at the end of the day, it's a whole different way of practicing medicine. Now, this has been around for a while. There are companies like Heal that I know quite well have been around. But as soon as it was approved from a payment perspective, the insurance companies and Medicare, et cetera, these now approaches have lit up. Now, the point of that is that people will get used to that. And if you have the option of not going to the doctor's office and waiting in the reception area for, as you know, a very long time sometimes because things happen, that could be attractive to you. It doesn't mean you'll never go see a doctor again, but it could be an attractive alternative. You look at things that are going on in commerce. Of course, everybody talks about the big commerce player being Amazon and what they've been able to do in non-prescription drugs. It's like a 9-fold growth, if I'm not mistaken. But even small groceries, small retailers and the stuff, at least in our environment, are using things like Instacart. You can order and deliver everything to the home. So all those patterns are going to continue to expand. Telemedicine, touchless payments, e-commerce, those sorts of, down to the small retailers, small grocers, those kinds of things. I believe that the consumer will change, and as a result of the consumer changing their consumption patterns, it creates opportunities for big tech.
Sam, talk to us, as the former head of a big public company as well, about the role of a public company in this world. We now have the government handing out a lot of money, sometimes in exchange for equity. At the same time, some companies are becoming criticized if they're not socially responsible. Is ESG more important than ever?
I think, first of all, I'll start with ESG, or social responsibility, connecting to your society, was always fundamentally important. We can argue about the extent that people did that or not did that. We can talk about the pressure of short-term, investment, et cetera, but fundamentally, it was strategically important to your brand. Because if you do things that are valuable to your individual customers or to society, your brand will be enhanced. Your value will be created. And that will show up in your shareholder price as well. So I think it's always been important. I believe, quite honestly, large companies today have been extremely responsible. I mean, if you look at what people are doing, whether it's 3M or whether it's going on in biotech, you just talked about Gilead, what they've been able to do in a very short period of time as well. You talk about what other guys are doing to help in the pandemic. Even the energy companies that are constantly maligned, from sustainability activists and those sorts of things, turned over their chemical facilities to produce the chemicals that go into the products, such as PPE and those kinds of things. So, and automotive with Ford and GM and ventilators, all those things. I mean, those guys have been phenomenally responsible. So I believe that, that kind of behavior, when you get into a crisis, big companies are stepping up. There's no business case to justify some of these things in this environment, which we all do understand. But fundamentally, they're doing the responsible thing. You even see some creative things in small companies. There's a small little company in Connecticut and New York. It's actually created the platform and technology that allows people to get back to work faster. I mean, I won't go take you through all the details, but basically it certifies your test results in your health. And whether you're working in the work or you're going into a restaurant for that matter, or you and I in the studio again, it'll say, hey, Sam's technically healthy. He's passed all these tests, and it's on his phone, and you let him in, and he goes on. And we can do this again like we used to do it live in your studio.
Sam, you've had a lot of experience with supply chains and a lot of experience with China. Do you anticipate that one of the consequences of this pandemic, when we come out of it, which we will at some point, will be some permanent changes in our relations, our business relations with China, and for that matter, in extended supply chains around the world?
Well, I'll start with what should have happened in the supply chain, then where it goes, because I think it's important to understand. Supply chains should have been designed for resiliency. By that I mean you have multiple alternatives. So you didn't have a major component in one geography, wherever it happened to be, so you could rebalance if a crisis occurred. That could have been a tsunami. It could be weather. It could be lots of things. It could have been a military action. I mean, we all designed our supply chains so if those events occurred on a global basis, you could readjust. If you look at the companies that have not been as impacted as dramatically by this, they're the ones that had I'll call it a resilient, balanced supply chain. What's driving the changes to the supply chain, quite honestly, David, is the fact that technology more so than low cost. So therefore, which drove it up until I'd say maybe 10 years ago was cost. Where do you locate for cost? And you see that all over the world. Yes, a lot went to China. China became the manufacturing hub of the world. There's no doubt about it. However, that was more of a cost-driven scenario. It started with the trade negotiations, but fundamentally people were looking at this thing and say, look, I need to have flexibility in my supply chain. I also want to be close to the market so I can respond quickly. So if for whatever set examples I might use, if you have a market that's really strong in some area of apparel, you want to have some capability there. Now that's enabled through things like 3D printing and all these other technologies that are now available to you. But fundamentally, it's going to be a balancing act of resiliency and responsiveness to your customers over time. That is what's going to drive the supply chain. We've done a lot of work in supply chains and why it's so important to stimulate them to get people back to work. But fundamentally, long-term, strategically, everybody's going to rebalance those supply chains to make sure they're more resilient going into the future.
That was Wall Street Week contributor Sam Palmisano. Coming up on Wall Street Week, China is 2 months ahead of the United States in dealing with the coronavirus, and Starbucks is seeing both sides. We talk with CEO Kevin Johnson about what their experience in China taught them about getting back to business in the United States.
The U.S. consumer was much more sort of on the go, and so we think opening in the U.S., we're going to get a very significant result.
This is Wall Street Week on Bloomberg. Welcome back to Wall Street Week. I'm David Weston. Businesses in the United States have been closed for about 7 weeks now, but in China, it's been closer to 15 weeks. And China is well on its way back in many of its businesses. Starbucks has seen it in both places. And we talked with Starbucks CEO and President Kevin Johnson about what they learned in China that might help us get back to business here in the United States.
There are phases that every market around the world goes through. And the first phase, we really refer to that as sort of the mitigate and contain phase. And that period lasted for 3 weeks in China, where people were asked to shelter at home, businesses were shut down, social distancing, all with the focus on how to flatten the curve and slow the spread of the virus. Coming out of the mitigate and contain phase in China, we then transition into a phase that we call monitor and adapt. And monitor and adapt basically means we begin to reopen stores, but we reopen them with different store protocols, amplifying safety. Oftentimes it's for mobile order for pickup only. And we did that in China, while at the same time we monitor the number of COVID cases that might pop up in cities around China. And in the U.S. here, we are now just coming out of the mitigate and contain phase. We've been in that for 6 weeks now in the U.S. And as we transition into this monitor and adapt phase, we plan to reopen over 90% of our Starbucks stores by early June. In fact, next week, the majority of those stores in the United States will reopen. And we will reopen using safety protocols that we developed in China and have adapted for the U.S. We'll reopen in a way that provides our customers a safe, familiar, and convenient experience. And so we're excited for next week. Many of our Starbucks partners are referring to it as homecoming week, because they too, like all of us, have been sheltering at home, and we're ready to get out and do something, but do something that's safe and responsible. And that's the balance that we work to strike in this monitor and adapt phase.
As you say, Kevin, as you came back online and you have the vast majority of your stores now in China back up and running, as I understand, you have modified your hours, modified how many people can be there. I see that the same store sales, even though you have almost all the stores open, are down somewhat. Can you tell how much of that is just reluctance on the part of consumers to come back out and buy things, as opposed to just having fewer people in the stores and shorter hours?
Yeah, it's a combination of all of those things, David, and I can't necessarily attribute it to any one, although I do know that in our store protocols, for example, in China, most stores are not open for seating. They're open for customers to come in for takeaway in China. And some stores have limited seating so that we can enforce social distancing. And one of the differences between China and the U.S., in the U.S. pre-COVID, over 80% of our customer occasions in the U.S. were for takeaway or to go. And so the U.S. consumer was much more sort of on the go. And so we think opening in the U.S., we're going to get a very significant result. But the positive news is every week we see continuous improvement in China as we monitor and adapt. We turn the dial up slowly and start to open limited seating, open other services. And now as we begin that path in the U.S., we're very optimistic that, by the end of May, early June, we're going to have a much better perspective on how quickly this is going to recover.
So as a last question, Kevin, talk about the long term, about growth for Starbucks in this new world. Where do you see growth? And let me be very specific. You and I have talked in the past about how many stores you're opening in China. Is it going to be fewer stores you're opening in China? I saw Luckin is really having some trouble. Can you take market share there?
Well, I think we've been taking market share, throughout this entire period. But what's important is we've been in China for over 20 years now, David. And throughout that 20-year period, we have worked to establish an admired and trusted brand in a way that resonates with our Chinese customers. And that's by showing respect to the Chinese culture. It's designing stores that are appropriate, that have artwork and built by local craftsmen. And our partners in China are fantastic. They create that magical Starbucks experience. And because of that, we're on a path. Pre-COVID, we're opening 600 new stores a year. This year, that's going to be over 500. But next year, we're going to go right back to 600 new stores a year. We have long-term growth opportunity in China. You think about it, it's a very large population. It's primarily a tea drinking culture. We're introducing them to premium Arabica coffee, and it's been working. And so we're going to continue to play the long game in China. And our other lead growth market is the United States. And so the two lead growth markets of China and the U.S., we're bullish on those growth markets. And then you back it up with the Global Coffee Alliance with Nestle and how that becomes a brand amplifier. You put it all together, our growth at scale agenda is relevant, it's intact, and it provides a long-term growth opportunity that we are confident in and we believe in.
That was Kevin Johnson, President and CEO of Starbucks. Coming up, we wrap up the week with our special contributor, Larry Summers of Harvard. This is Wall Street Week on Bloomberg.
The fact that this one has gone so far has to mean there's a substantial chance that it's the one for this half century or this century. And the events that take place that infrequently, the worst of them, kill a number of millions of people and quite possibly as many as 10 million people.
That was our special contributor, Larry Summers, believe it or not, almost 3 months ago now, way back on February 6th on Wall Street Week. And I must say, he's joining us now. Larry, when I heard you say that, I was flabbergasted. And frankly, I was a little dubious, but it turns out you were ahead of your time. You had it called way back on February 6th. So now I have to ask you, what are you worried about now?
David, let me first say I wish I had been wrong in what I said in February. I think these events are going to define the history of the first part of the 21st century. David, I'm more alarmed than I have been at any time in the last 6 weeks, because what I see is that the United States is pursuing a strategy of hope and prayer, not a strategy with a rational foundation. None of the preconditions that were set several weeks ago for opening up have been met. Caseloads have not declined sharply. In fact, they have plateaued, and we're opening up anyway. There's no consistent presidential leadership. Here's the way for your viewers to understand it. People think about a disease like this in terms of a statistic, capital R0. Capital R0 measures if a person gets it, how many other people are going to catch it through contagion. If R0 is greater than 1, it's like 1, 2, 4, 8, 16, and so forth. It explodes. If R0 is less than 1, it's like 1, 1/2, 1/4, and so forth, and the disease contracts. In normal times, what the scientists tell us is that R0 is about 2.5. Today, R0 is perhaps 0.8 or 0.9. That means that if we go back even 20% of the way to normal, we're going to be in a situation where the disease is growing and exploding, unless we have some offset strategy. We don't have any major offset strategy, and we're starting to open up, and it's probably going to be at least 20% of the way back to normal. So we may get a break for several months because of the summer and the warm weather. I'm not sure about that, but it's possible. But we are basically on a strategy where we're not doing anything to prevent substantial recurrent growth of the pandemic. The consequence is going to be large numbers of people are going to die who could have been saved. And because of the pervasive fear that's going to come when the pandemic comes back, we're going to have longer, deeper economic problems than we otherwise would have had. What a responsible country, responsibly led, would have done is it would have recognized that this was a global problem and that the United States not needed to lead the world, not to defer to its governors and mayors. It would have recognized that we needed pervasive testing so that people, certainly every health worker, certainly everyone who's working in a nursing home, certainly everyone who's going to be coming into contact with hundreds of people, certainly everyone who's been in contact with someone who has the disease are tested and tested frequently. And if they have the disease, are quarantined so that we contain the growth of the disease. We would have had a carefully designed strategy around who is going to go out and who is not going to go out based on their perceived vulnerability and the vulnerability of the people they live with. We would have had extensive contact tracing, and we would have recognized, and this is maybe the most important point, that if we're not wasting money trying to stop this, we're not spending enough money. That there are multiple tests that might work. We need to be investing in mass producing all of them. And if there's some waste, it's trivial compared to the $80 to $100 billion a day that this pandemic is costing us. That we could throw money in massive scale at testing, and it wouldn't be more than 2 or 3 years loss from the pandemic. And we're not doing any of that because we don't have any kind of national strategy, because we don't have any kind of national leadership. And when the United States is failing, it means the world's failing.
Right. So, Larry, I understand there's not the strategy now that you want to see, we think we desperately need to have. Do you can see we may be moving toward that strategy? We had a big announcement at the White House that we seem to be ramping up the testing a fair amount, may not be there yet, but getting in the right direction. And on contact tracing, we have real substantial efforts, such as in New York, such as in Massachusetts. It may be the governors, but are we at least moving toward that strategy?
I think we're groping towards the right elements, but the difficulty is that we're throwing everything loose and open and having people go out again and be in connection, be in contact with each other much more rapidly than we're getting any of that going. And frankly, the national strategy has been so inconsistent that nobody can rely that today's commitment to testing will be tomorrow's commitment to testing. But yes, David, you're right that there certainly are some tendency to move in some of the appropriate directions, and that should be applauded. But this is a war, and what we're seeing is not anything like the kind of leadership we expect in a war, that we expect that America's had in the past in an existential struggle. And ironically, it's probably going to have big costs both on health and on economics.
Well, let's talk about the economics just for a moment, because we had central banks, both the Federal Reserve and the ECB, step up again this week. At the same time, you had a month in April where the stock market went up more than it has in any month since 1987, in 33 years. Is the market agreeing? Why is it reflecting that rather than what you're talking about? Because you said you're more concerned than you've been in a good long time.
I think the market's reflecting a sense that there's a wall of money being put underneath companies. And for as long as that's going to happen, perhaps their valuations will be pushed up. And I don't think it's connected to economic reality. I think the Fed was absolutely right to think that when it looked like all the financial markets might collapse a month ago, that it needed to be very aggressive. And I strongly supported it at that time. But we are having companies that should be raising equity so that they're stable and they can survive. Instead, raising debt and instead becoming ever more levered. You saw that in Boeing, which has a million problems ahead of it. It should have been diluting its shareholders and raising equity so that it could survive. Instead, it's issuing junk bonds in the knowledge that the Fed is standing behind it to buy those junk bonds, both directly and indirectly through exchange traded funds. So we are engaged in the temporary expedient of a massive leveraging up of American companies, which is enabling them to look out for their shareholders by not levering by not issuing equity, indeed by dispersing cash through dividends. And there are even some few companies, I suspect, who will be still repurchasing shares. I'm very worried that central bank debt socialism is a temporary expedient, not a long-run growth strategy.
Well, and that's the question, temporary. What you're saying sounds like there's going to be a reckoning. We're going to have to write down a lot of those assets. What will trigger that, in your opinion?
I think when people come and clearly see that wishing things doesn't make them true, and wishing that we can just open up and prosper isn't going to be a self-fulfilling prophecy, as people start to see the health consequences and become more apprehensive, as people look and realize that we can't freeze every job and freeze every business through something that's likely to be quite long-standing.
Right. So, Larry, it's so good to have you as a special contributor. We're going to come back in 3 months and replay this and see where we're at that point. Because, as I say, you were very prescient the last time, even if we were skeptical. That is Larry Summers from Harvard.
I'm wrong, pessimistic. I really do.
Yeah, there you go. There you go. I hope so, too. Thank you so much, Larry Summers of Harvard. That does it for Wall Street Week for this week. This is Bloomberg.